Let's look at what's happening in the Indian real estate sector a little closely. In India, the real estate sector is undergoing a fascinating transformation. As of July 2024, the Indian real estate market is seeing a remarkable growth, driven by a variety of factors in different city tiers. Firstly, in the metros and tier 1 cities like Mumbai, Delhi, Bangalore, Hyderabad, property prices have surged by an average of 15% over the last year. This growth is fueled by increased urbanization, a robust IT sector, and growing number of high net worth individuals seeking premium properties. For example, in just Bangalore, the heart of the India's tech industry, residential properties have seen a steep 19% increase, and in some IT hubs, even by a staggering 32%. Even tier 2 and below cities are not far behind. Places like Pune, Jaipur, Lucknow are also witnessing an impressive growth, averaging around 15% year on year. Now, these cities are becoming attractive due to their relatively lower property prices, improved infrastructure, and the government's push for smart cities. Pune, for instance, has seen property prices rise by 16% as it emerges as an educational and IT hub. Similarly, Jaipur's real estate market has grown by 14% thanks to its better connectivity and urban development projects. Now, several key drivers are behind this growth as well. One major factor is the government's push for infrastructure development, including the construction of highways, metro projects, and smart city initiatives. Now, these projects are making tier 2 and below cities more accessible and more livable, thereby attracting both residents and investors. Additionally, like elsewhere in the world, the rise of remote work has prompted many to move away from the crowded metros to more spacious and affordable homes in smaller cities. Clearly, in India, things are looking good. Whether
Yeah,
you're in a
definitely.
metro, whether you're in a small town, it doesn't matter.
Yeah.
Year on year, there is a lot of appreciation that is happening. Now, what I really want to understand is this a very natural or sustainable kind of a phenomenon, or is there any sort of, a crash? Not even a crash. Is there any sort of a slowdown possible in this sector? Will it just keep going?
See, a lot of people are talking about bubble, so-called bubble
exactly.
in real estate. Prices are going up by 50% in 2
Right.
years or something like that. If you look at the data, RBI published housing price index. Okay, there is a company, National Housing Bank, that also published housing price index. So consolidated deals, if you see, across country, across categories.
Globally.
India, only India.
Okay.
It's hardly 5%, 5 to 6%. Okay.
This is specific to real estate sector?
Specific to real estate sector.
Okay.
Okay. In 2008 to 14, when we last saw bubble, CAGR was around 20%.
Okay.
Small towns, Meerut, Muzaffarnagar,
Right.
Hapur, small UP
Just with
towns.
the blind optimism of saying,
Just that we want
Yeah.
a slice of a real estate boom. We also want to make money. Okay. No, looking at the law and order situation and overall infrastructure, there was no realistic possibility for anybody to live there. Forget about the commercial
and
opportunities.
how is that changed today? You see.
See, today, if you look at the data, if you go beyond that 5% headline number, 5-6% headline number, okay, the real estate boom is very strategic.
Okay.
Most price increases, price rise, I would say, has come in Bangalore, Hyderabad, Gurgaon, Pune. Then it expanded into other areas like Noida, Greater Noida, Faridabad,
Faridabad, yeah.
Ghaziabad. So these now areas are well connected to Delhi. Okay, you could have easily lived there, enjoy the same quality of life again, take the benefit of commercial opportunities. Everything was there. There was no difference at all. Okay.
Would it be right to say that the current boom is also kind of boosted by government initiatives, which is like the whole smart cities? There is like pretty much connectivity. Things like metro is
In COVID, what happened? People went back to their hometowns,
Right.
and most of people are staying in tier 2, tier 3 cities. So suddenly there was a realization that you can live there. So
Right.
there are schools like in Delhi. If you have to put your kid in a school, you have to wait for 2 months. You have to wake up at 5 in the morning and stand outside a line. Outside in a line. There you can go old school in a school and simply pay the fee and get your kid admitted. In hospitals, there's less rush.
Correct.
Okay. So everything is available. You have those
But that is no longer the case.
online
right?
facilities is
but
there.
that is no longer the case. Like people are coming back to work. I mean, a lot of companies have made it mandatory.
What people have realized in 2021 COVID wave, that quality of life, the
Right.
same it's possible to enjoy same quality of life in some tier 2 tier 3 cities.
Right. And
Okay.
especially if it happens to be their hometowns, then so much the better.
Yeah, it's better.
Right.
Okay, so let's say if there's a quality of life index published by government,
Right.
urban development ministry. So they are Indore, Coimbatore, okay,
Jaipur.
Surat, Vadodara, Vizag, Visakhapatnam, Jaipur. These cities feature regularly in top 10
Right.
in terms of quality of life. The challenge is developing commercial opportunities. Okay. It's sustained growth which can give people job prospect, white collar jobs, create white collar jobs to
Right.
sustain this market. I'm telling you where is bubble. So there are cities like Kanpur, Lucknow, Patna, where they are at least 10 years behind before any commercial opportunity would come there.
Right.
Okay. You know, the luxury premium products, the big apartments, luxury apartments, they are almost selling at same price as Gurgaon and Bangalore.
That's crazy. In Kanpur and Lucknow.
Kanpur, Lucknow, Patna. Thing is that people from UP put their investment mostly in, Noida and
Right.
Ghaziabad. They're in their home state. But people who are from the eastern side of UP, the best options are these. Okay, so rich people are buying the big apartments there.
Those are not sustainable, is what you're saying.
That is not sustainable because that kind of pricing level, ultimately somebody has to live there.
Right.
Okay, the quality of life. That's it, I'm mentioning again and again. These two things matter: commercial opportunity and quality of life.
Yeah.
They are at least 10 years behind there. It will not happen in next 4-5 years. Like in
Correct.
case of Indore, Surat, Ahmedabad, Vadodara, we are talking about. It will happen expected that it will happen in next 4-5 years. Okay.
Right.
But that would not happen in next 10-15 years. So it would be a very low volume market.
Right.
Okay.
So
And
if I hear you correctly,
Yeah.
what essentially you're saying is that definitely the surge in property prices across the country, by and large, 75-80% of it is systemic, it is justified, it is normal. It is a normal progression of
it is
the
a
development.
basically, I would say, price convergence. So
Okay.
it was a initial stage, it was a price convergence of tier 1 metro to Delhi and Mumbai.
Right.
Okay. In second stage, it was a price convergence of satellite cities to tier 1 metro cities.
Correct. Correct.
Now we are looking at third stage where the tier 2 cities with high quality of living,
Right.
they might converge to satellite cities. and
Having
tier
said
1
that,
cities.
these are the kind of pockets where there might be a bubble. Now, until recently, and I mean even like a week or so ago, our social media feed was overloaded with people's anger and disappointment at this year's union budget. And no cry was as loud as it was against the removal of indexation benefit while selling property. Now, indexation benefits allowed property owners to adjust their purchase price against inflation. In essence, reducing their taxable capital gains when they are selling that property. Without this benefit, the taxable amount on capital gains could be higher, potentially discouraging investment. However, this move is partially offset by a reduction in long-term capital gains on real estate, down from 20% to 12.5%. This reduction aims to stimulate the real estate sector. The net impact of these changes is actually a bit of a mixed bag. While scrapping of indexation benefits increases the tax liability, the lowering of long-term capital gains tax could balance it out, at least for some investors. Let's break this down with the help of a couple of examples. First, let's look at Ravi. He bought a property back in 2000 for a princely sum of 30 lakhs. Today in 2024, he's selling it for an appreciated value of 1 crore. That's a net capital gain of around 70 lakhs. In the old regime, he could have indexed his purchase price of 30 lakhs and gotten an indexed value of 64 lakhs today. This means his net tax liability is not on 70 lakhs, Instead, it is on just 36 lakhs. And this capital gain will be taxed at 20%, which brought his tax payable to 7.2 lakhs. However, now with the new regime without indexation benefits, he is going to be taxed on the entirety of 70 lakhs, but at a lower slab of 12.5%. This brings his tax payable to 8.7 lakhs. Essentially, the new regime increases his tax burden by nearly 1.5 lakhs. But hang on, it's not the same story for all investors. Let's look at Priya, for example. She bought a house in 2019 for 1.2 crores. And today in 2024, after 5 years, she's selling it for 1.75 crores, making a net capital gain of 55 lakhs. In the old system, her indexed price would have been 1.35 crores, which would have resulted in she being taxed 20% on the 40 lakhs of capital gains that she made, which would bring her tax to 8 lakhs. However, in the new system, she is taxed on the entirety of 55 lakhs but at 12.5%, which brings her tax down to 6.8 lakhs, essentially reducing her tax burden by almost 1.2 lakhs. In essence, the new system penalizes the sale of longer held properties while benefiting quicker resales. So, how will this reality actually play out for the real estate sector itself, and what would be the dynamics? Well, let's find out. There are two aspects to it. One is the how old is your property? That is
How old
point
is your
number.
property? What is the price appreciation?
Correct.
Lot of aspects are there. You cannot say that it's bad for me or good for me just right
Right.
away. The second most important point is one thing people need to understand: hardly anyone pay taxes on property gains. Okay. So if you're selling a property after 2 years, it comes under LTCG,
Right.
long term capital gain. Okay. If you invest those gains in a new property within a year, within 2 years actually, okay, or you will put it under construction in next 3 years, or you can also use this retrospectively for property you have bought 1 year earlier. Okay, if you are investing those gains, there are zero taxes. Most of the people sell a property and buy a new property. I've
Right.
hardly seen somebody selling a property and putting it in stock market or buying a bonds of it. Okay, even if you go for bonds, there are bonds which are available in the market, where you can invest gains, but they are
Right.
locked for 5 years and returns are low.
Right.
Okay, so that option is there, but you can hardly anyone pay taxes. Most of people buy a new property. 99% of
Correct.
people buy a new property.
Which you can still do.
Even if you need a cash flow, most of people mortgage the property, get the money. 15 years ago, it was quite common. So most of my friends who went to US and UK for higher studies, their father mortgaged their house, got the money and sent them there. Okay, but I never saw anybody paying taxes ever.
So in a way, it will incentivize you to reinvest that money into the same
real
sector.
estate sector. Okay.
Yeah.
So it's not a negative for real estate sector. Okay. And actually it's not a negative for a big, I would say extremely large majority of real estate owners.
Right. So because you're saying that most people, when they sell a property, their intention is not to take that proceeds and do something else with it. By and large, 85% of the people use it again to buy another property.
Buy another property.
Okay. So now this brings us to another interesting question. So suppose I'm not a home buyer. Okay. Now suppose I already have a house. I don't intend to buy a house to live in it. But I believe that there is probably gains to be made in this sector. So I am looking for some exposure to real estate sector. What should be my plan of action?
A few years ago, as real estate boom took off in our times, I would say post 2020, there were few companies which are offering real estate as fractions. So basically, they buy a property like a house from a apartment offered by Prestige. Okay.
Are these REITs you're talking about?
Yeah, I'm talking. So right now their status has been changed to REITs.
Okay.
Okay. So REITs, the problem with the big REITs, which are listed, Embassy, Mindspace.
They're mainly commercial.
First of all, they are mainly commercial.
Right.
Second thing is that you do not have any control on the operations. You don't know what they are doing, and so you cannot. And there is no variety in the choices which are there. So embassy has some properties. They will add more properties. You cannot choose which property exposure you want.
Correct.
Okay, so that kind level of flexibility and options are not available. So whatever they are buying, and they take all the calls. Okay, so in fractional real estate, what was happening that you buy an apartment and distribute among multiple people. Okay, here you can make some choices. Okay, you can choose which
But
apartment.
is that the thing? Like, does it still exist? Fractional real estate?
Fractional real estate, there have been some really positive developments. Okay, so you can you understand what I'm talking about. You
Yeah.
buy an apartment, you distribute its
Correct,
pieces
correct.
among 100 people.
Yes.
Okay, so ticket size is quite small. The
Right.
issue was, first of all, their regulation was not very clear. Okay, consumer how the consumer interest would be protected. Second thing was which used to bother me a lot when I was looking at it, is the liquidity.
Right.
How would I exit? Okay, where is the liquidity? I am dependent on the issuer or the sponsor, scheme sponsor. So what happened in March 2024, SEBI released detailed guidelines for fractional real estate companies, and these companies have been asked to register with SEBI as SM REITs. So it is now a SEBI regulated sector. These REITs would be listed on stock exchanges. Even now, at this point, we don't know how much would be the interest in buying out these units from the stock market investors or the people who are doing trade on stock exchanges. But there is one additional option that is being provided.
Got it.
So entry level is 10 lakh rupees. It's affordable for most people. Okay. Your property is managed by professional managers. Okay, who are taking a call on the property. You can discuss with them why this property and what is the rationale behind choosing this property, what is the appreciation they are looking at. Okay, so it's like mutual fund managers. You are a mutual fund manager, you can have a discussion that why their mutual fund is better. A fund manager.
Right.
So here you have a property manager, basically real estate fund manager, with whom you can have a discussion, because it's a small concentrated group of 200 people and a small size. That manager it is possible to actually connect with the manager and have a discussion about the rationale behind the investment.
Got it.
So it's a I would still say if things go wrong, okay, when you own the property, you have hundreds of choices. You
Right.
can mortgage that
Right.
to get money. Okay, if it is not getting you are not getting an exit. Okay, you can put it on rent to generate additional cash flow. These kind of comfort
Yeah.
and options would not be available with SM REITs. But if you are just looking for a pure portfolio diversification perspective,
Yes.
to take a slice out of real estate market, commercial, residential, like the exotic things you are talking about, breweries, wineries, farmlands. Okay, so these options are really good.
Remember, we bring these insightful discussions every fortnight. So make sure to subscribe to our podcast and for more content on business, finance, and investing as well. And if you're looking for an even more in-depth analysis, don't miss out our monthly newsletter, Amplify. It's packed with detailed coverage of significant financial events from India and around the world and what they mean for you as an investor. You can find the link in the description of the newsletter. Thank you for tuning in, and we look forward to having you again next time. Until then, stay informed. Happy investing.